Hey everybody, what's going on? It's James here with Crypto Common Sense, and I wanted to shoot a risk management video for you today. And if you're going to skip this, don't, right? Unless you already have risk management figured out, unless you already have a consistent winning track record with trading, I strongly recommend you watch this video because I'm going to break down how trading really works. Everybody has a different system, and I'm not saying that this is the only system that works. Right? There are successful traders that use a different style of risk management, but for most people, this is a system that they can latch onto that will work very well for them and help them to be consistent with their trading. So instead of having, a loss where they might take, a $1,000 loss here, and then suddenly they're winning $100 here, $100 here, $100 here, right? The old rule of thumb is you use 2 to 1. But that's only a very, very, small piece of the puzzle. If you're using 2 to 1, but your losses are, $50,000 losses and your wins are $500 wins, 2 to 1 doesn't really mean anything because now you're going to have to win 100 trades to pay for that one loss. So we're going to talk about all this. I'm going to walk through it. I'm going to keep it fairly brief because it doesn't need to be a long video, but I want to walk through this because especially when I look at social media, I see a lot of guys who are all over the place with their trade sizes. One trade they're doing a $50,000 trade. One trade they're doing a $400,000 trade. One trade they're doing a $100,000 trade. And, then you look at their stops. A lot of them share their stops, and it's like, I don't know what kind of risk management they're using. Obviously, I'm not here to judge their system. If it works for them, great. But I'm saying for the average person, you have to be consistent. If you're not consistent, you're never going to last. All right. So before I jump into the video, please do me a huge favor. Hit that thumbs up button. Make sure you subscribe to the channel. And, of course, make sure you click that bell icon to get notifications when I release new updates. So we're just going to, in this example, we're going to use $25,000 as the trade fund. This works whether you're trading with $1,000, $10,000, $100,000, $1 million. The reason I'm using $25,000 is because that's the amount of money required to be a pattern day trader with stocks. Okay? If you're outside the United States, it's probably not like that for you. But if you're in the U.S., you're supposed to have $25,000 in your broker account to trade day trade stocks, meaning you trade more than 3 times a week. Okay, round trip trades. So we'll use $25,000 in this example. Now, the general rule of thumb with trading is you shouldn't risk more than 3% per trade. Personally, I don't risk 3% per trade. I'm a 1% guy. I'm a very conservative, very risk-adverse type of trader. The reason I'm like that is because I like making my nickel and dimes, and I make them over and over and over and over again. And when I lose, it doesn't put me in a position where I can't come back from it, right? Yesterday or the day before yesterday was actually 3 years that I've been trading. Statistically, most people don't make it past 2 years, right? So I kind of feel like I beat the curve. Kind of feel like, I arrived here through consistent risk management and a few other things, okay? So in this example, let's say 1%, and then I'll show you the difference in 1%, 2%, 3%, etc. Okay? And I just have some very basic trades laid out here. Your stop losses, they're always going to vary, right? When you enter a trade, your stop loss should not be an arbitrary number. It shouldn't be, well, every time I enter a trade, my stop loss is 5%. Or every time I enter a trade, my stop loss is 0.25%. It should be based on the chart, right? So I don't want to get too deep into that because that's a whole other lesson, but your stop loss should be based on the chart. Just understand that. But in this easy math example, we're going to say this trader is using stop losses of 5%, 3%, 1%, 0.5%, and 0.25%, which would be like a scalp, okay? So, and I'm not even going to talk about these a whole lot. I'll go over them in just a second, but I want to focus on this one because this is the one where the risk management is the most important because the fees are so bad, okay? So in this example, let's say this person has a $25,000 trade fund, okay? And let's say that they're doing a trade with a 0.25% stop loss, right? So that means that, let's say they're doing a 2 to 1 risk reward, RR, right? 2 to 1. What that means is they can risk $250 per trade, all right? $25,000 times 1%, they can risk $250, all right? Now that doesn't include fees. So if you look at a 0.25% example, trade size would be $100,000. Why? Because if you have a $100,000 trade times a 0.25% stop, 0.25% of $100 is $250. This is how leverage works, okay? This is how leverage works. Yes, you can trade with more than your entire trade fund because you're using proper stop losses and proper risk management. You're still not risking more than 1%, okay? So how would a person get $100,000 trade. Well, they could put $25,000 in the exchange and use 4x leverage. That's one way. Personally, I wouldn't recommend it, right? I don't keep that kind of money on exchanges, all right? I don't keep, and by that kind of money, I mean 100% of my trade fund, right? What I do is I break it down and I keep a smaller amount. So if I'm mainly scalping on an account, what I'll do is I'll try to keep enough where my leverage can be around 60 to 70x, which is what this is over here. So say you have $1,000 on there, it would take a 100x leverage to meet that. You really don't want to be maxed out on your leverage in case something wonky happens. So maybe you keep like $1,250 over there, all right? Well, now you got $1,250 on the exchange, and you can do these trades right here, $100,000 trades with 80x leverage, right? And your 1/4% stop loss is fine. In fact, you probably want to do more like 1,500, right? Let's do 1,550. I'm not a big fan of 666s. All right, so let's say you keep $1,550 in there, and you're doing $100,000 trades. You're using 64x leverage. There you go. You're not going to get liquidated 99 times out of 100 because your stop's going to get hit first. Once in a while, you might have something really, really weird happen where there's a ton of slippage, but in those cases, you know, that's trading, right? That's the small risk you run when you're trading with leverage. So in this case, this person keeps $1,550 of their $25,000 on the exchange, and you can see here they're able to do $100,000 trades. They're able to risk just $250 per trade. Now, if they lose that trade, right, they're going to pay a taker fee on the entry, which is 0.075% on this exchange, and they're going to pay a taker fee on the exit, which is 0.075%. So they're really losing $400 because they're losing their stop plus the fee is $400. So their risk management, it's not really 2 to 1. 500 to 400 is almost 1 to 1, right? And you have to remember 500 that's gross profit. So you still have fees coming out of that. Your fee on a win, you know, is going to be about 0.05% because you're usually going to, enter a trade, or at least I enter trades as a taker, right? I enter on closes of candles, so it's a market entry. So I enter as a taker, I exit normally as a maker on a limit order, so my fee is 0.05%, meaning on a $100,000 trade, my fee is right around 0.05%, $50, right? So you're making $450 on a win, you're losing $400 on a loss. So almost 1 to 1 on a scalp, okay? So let's say this person does 13 of those trades a month, right? Which, by the way, is not a lot. In a busy month, I'll do 90 trades, okay? Because I am more of a day trader than anything else. When I do my position trades, they're typically trades that I take and hold for months and months and months, right? So like the last position, and I usually only long on position trades. That's another thing, right? I usually don't try to short and hold it down because you're paying all those fees. But I'll long a position trade because I can buy a spot and just hold it. So for example, in December of 2018, I entered long position trades on Litecoin and Bitcoin, right? And I held those until the summer of 2019. But I didn't take any position trades on the short, even though I've been macro bearish since June. All of my shorts were swing trades and day trades. There was no position trade that I opened and just sat and paid fees for 9 months, okay? So let's say that, you know, this person is scalping. Let's say they're making 13 trades a month. They're winning 9 of those trades and losing 4. Now you might be saying, wait a minute, you know, don't people usually get like a 50-50? Not on scalps, right? If you're doing scalping properly, I run about an 80% win rate on my scalp trades, okay? But in this example, let's say this person's getting 69% win rate. That's a gross profit of $4,500, a gross loss of $1,000 plus fees, right? And these fees right here are figured on all scalps, right? It's the worst case scenario because the fees on the other trades are smaller. Worst case scenario, right? Meaning that, the 9 wins, they pay 0.05%. And on the 4 losses, they paid 0.15%. So it's $1,050. That's a net return of $2,450, which is a return of 9.8% per month, which, by the way, is phenomenal. Phenomenal, okay? But it's because you're using leverage. That's the reason you're able to get a return like that, all right? That's how leverage works. That's how risk management works. And that's how your stop loss actually determines your position size. Now, watch what happens. Let's say a person sees a different trade. It's a swing trade. And let's say that they're like, you know what? I think this is a pivot point. I think this is turning the corner and, either going to go up or go down or whatever. So they set their stop loss at this one. Let's say that it happens to be 3%. Well, that means their profit target's going to be 6%. Does that mean they're going to take a $100,000 trade on this trade? Nope. Because their stop is bigger, that means that their trade size has to be smaller, right? So on this trade, they would trade with $8,333 because 3% of $8,333 is $250. So if they're right, how much do they make? $500. If they're wrong, how much do they lose? $250. And guess what? It's the exact same numbers no matter what their stop loss is. If it's 5%, 3%, 1%, half percent, it's always the same profit target and always the same maximum loss, with the difference being fees, right? In the case of this, like a 5% stop loss, it's a $5,000 trade. If you're going for a 10% win, $500 profit, 5% loss, $250 loss, fees a lot smaller, okay? So ideally, you want to get some of these trades. Also, what you're not seeing here, right? Sometimes you get into a scalp with a 0.5% target and it turns into a runner, where instead of getting a 0.5% profit, you make 1% or 2% or 3%. Perfect example last night. One of the people in my Discord group entered a trade. It was a scalp trade. He shorted Bitcoin at $9,600. What happened next? Bitcoin collapsed to 8 grand. What happened for him? He made about 15% on that trade, on that scalp, right? Which happened to be about 30 grand. 30 grand in 30 minutes on what started out as a scalp trade. So you will have those runners that more than make up for the fact that the fees are higher on these scalp trades. And if you do one of these trades, like where you're going for 10%, sometimes it goes further than you think and it turns into 20% and 30%. So these numbers down here, they're almost like a worst case scenario, right? Because they're not taking into the account the times that your trade goes in your favor a lot further than what you were looking for. Just because I have a profit target of 0.5% doesn't mean I'm automatically going to close it there, right? If it looks like it's going to run, or if it looks like I've caught the trend, right, then I'll exit on a taker order, but I'll let it ride a lot further, okay? So again, this is how this works. Now, if this person is trading consistently, let's say they're trading with $25,000, let's say they've been trading with $25,000 for, say, a year, 6 months, whatever, and they've just consistently won, right? They know their numbers. Maybe at that point they say, you know what, I'm going to bump this up to 2%. And what does that do? Using the exact same trade budget, $25,000 with a 2% stop loss, now their risk changes from $250 per trade to $500, which guess what? It means that this $25,000 trader can actually trade with $200,000 per trade and still, be within the confines of proper risk management, and their net profit simply doubles, $4,900, right? You can start playing with these numbers down here. Say this person wins 7 trades and loses 6 trades, 53%. Well, on a $25,000 budget with 2% risk management, there you go, net profit $1,500 a month. Not great, right? Still not bad, better than most, right? As you play this and make this 8 and make this 5, right? $3,200. So you can see how just little tweaks make a huge difference, right? We make this 3% per trade. Now that's $750 per trade. This person can be trading with $300,000 and still be, following proper risk management. How would they do that? Well, they can keep about $5,000 on the exchange, use 60x leverage, and there's their $300,000 trade. And they're not actually risking $25,000 per trade. They're only risking $750 plus fees, which is $1,200. And worst case, if the exchange went down or went out of business or went bankrupt or whatever, they only have $5,000 at risk, not their entire trade fund. This is how leverage is used to protect yourself. Leverage is not meant for gambling, right? Leverage wasn't invented so that you could go out there with a $1,000 trade fund and do $100,000 trades. That's not the point of leverage. I understand that some people on social media like to pretend that's what it is, like you can get rich quick, but you're going to lose your money just as fast as you made it, okay? Risk management and leverage paired together will allow you to grow a trade fund extremely fast while not ever putting yourself in a position to lose your entire trade fund on a single trade, right? You're always protected against catastrophic losses because you're only keeping a small percentage of your trade fund on the exchange, right? See how this works? You're risking $5,000 to systemic risk, and you're risking roughly $1,100, sorry, bad math, $1,200 per trade on a scalp, and as little as $773 per trade on like a swing trade, right? It makes a huge difference. And if you do this and you use it for every single trade, then you'll be consistent, right? What happens most of the time with people is they think, oh, this is a good trade, so I'm gonna go a lot bigger on this trade, right? Well, then let's say that trade blows up on them. Let's say that they're trading with 25,000. And let's say that they go really big on a trade, say 300,000. And let's say they lose $1,200, right? But then let's say that on most of their trades, they're only going, with 1%. So they're only making $500, right, on a winning trade. Well, now they've got to win 3 trades just to pay for the 1 loss, because they're not really using 2 to 1. They're using different numbers for every trade. But if you use the same risk management for every single trade, then you really can be a 50% trader and make a living. Look at this. 7 wins, 7 losses, net profit 350, right? Now again, I'm not saying that's a living, but as you grow, say you're using 3%, risk management, now it's $1,000 a month. Let's say that you grow your trade fund. Instead of taking profits, you keep rolling it back in. Now it's $50,000 for 3%. Even as a 50% trader, even doing all scalps with these huge fees, $2,100 a month. Then you keep growing. A couple of years down the road, you're at $100,000, right? Even with the huge fees, even doing all scalps, now you're at $4,200 a month, right? And again, this video is not to tell you, hey, I promise you're going to make such and such money if you do this. It's not even to, insinuate that you'll make money as a trader if you do this. What I'm telling you is this is step 1. This is how you stay consistent, and this is how you build a trade plan, and this is how you come back from losses, right? And as you tweak these numbers, it changes drastically. You can tweak this number. Instead of doing 2 to 2, let's say this person only enters trades where the risk is 3 to 1, right? Well, now, look at this. Net profit 25 grand. Whereas if they're doing only 2 to 1, net profit 4,200. So let's go back to a $25,000 trader using 2 to 1, $1,000 a month, right, roughly, winning 50% of their trades, 14 trades a month, okay? Change that 3 to 1. Now that $25,000 trader, winning half his trades, is making $6,300 a month. See? Risk management. You trade sizes. Don't start with, what's my emotions like? How good do I feel about this trade? Your trade size should be based on your stop loss. Whatever your stop loss is, whatever your risk tolerance is, right? Whether it's 1%, 2%, 3%, 0.5%, right? That's what should determine your trade size. And if you do that, you'll stay consistent. So I'm going to go ahead and wrap up the video there. I hope you guys enjoyed this. Yes, I will be shooting a weekly update video probably this evening. I want to wait for the weekly close. I know Bitcoin had a huge dump last night, but I think it's a little soon to call that bearish, right? I'm a macro bear, but I'm still, trade the charts. And right now there's some stuff in the charts that could go either way. So I'm going to wait for the daily close and the weekly close, and then I'll shoot a weekly update video for you guys. All right, this is James with Crypto Common Sense. Please remember that I am just some guy sitting in a spare bedroom. So nothing in this video is financial advice. You should always seek out professional financial advice from a licensed financial advisor for making any type of investment in cryptocurrency or the stock market. Again, this is James with Crypto Common Sense reminding you to please trade safe.